up to 30th June the following year. So we are currently in financial year 2023-2024, which has run 10 and a half months. So we are just 1.5 months to go. And by constitution, the government of Uganda, through the president, has to table a budget of his proposed expenditure and revenue sources for the following year before the expiry of the financial year. So the president has to table through the Minister of Finance, delegated authority, his budget for financial year 24-25, starting 1st July 2024, by the 3rd week of June latest. And normally, the budget is presented to Parliament for approval in the second Thursday of second week of June. So it's likely to be on 13th June if nothing changes. And of course, in terms of that process, it starts early, the budget cycle starts early, and in March this year, already government has presented its initial budget of about expenditure of about 58.3 trillion Uganda shillings. And of course, it comes up with proposed revenue measures, how it will generate revenue to fund that budget. And one of the key important sources of revenue is tax revenue, which normally changes year in, year out. But this year, they also came up with some tax bills to be able to finance that budget, which are tax amendments. As you may be aware, tax can only be collected if supported by an act of parliament. And that act of parliament, the process starts from the bills. Once the tax bills come through, they are presented to Parliament for discussion. Parliament can accept all, can adjust, can amend. And once Parliament has approved the final bills, which will now become acts, they go to the President for final assent. Once the President approves, then that becomes law. And normally, the acts are implemented 1st July as at the start of the fiscal year. As Ernst & Young, probably for you, many of you know Ernst & Young. It's one of the top 4 global professional service firms with over 250,000 people worldwide. And also it has locations in over 150 countries. And in Uganda, we are also having a presence here of Ernst & Young, Certified Public Accountants of Uganda. And one of our key obligations and where we do things, we want to normally tell the public, our clients, and the wider public, once tax law is passed, it's mandatory. And in law, ignorance is no defense. So we normally prepare our clients and the general public to know what is coming, and because tax law changes every year, it's very difficult to keep track of these changes which come in year after year. So we normally do a process, and this is the start of the process. Even when the budget is ready in June, we shall do a more detailed budget breakfast, and we tell you, our clients, for those who attend the breakfast, either physically or virtually, what are the issues which have now come out, which you need to prepare as we go into the financial year. And your host today, my name is Sempija Mohamed Moses. I'm a tax partner at EY Uganda. Ernst & Young is abbreviated as EY. So I'm the tax partner EY Uganda. And I've been with this firm for 25 years now. Before, I worked with the Uganda Revenue Authority, who is the tax administrator for taxation in Uganda, for about 6 years. So I've had about 30 years plus tax experience. And in terms of my training, I'm a chartered accountant. I'm a fellow of the Association of Chartered Certified Accountants of UK, ACCA, I'm also a certified public accountant of Uganda, CPA Uganda. I'm also a certified public accountant of Rwanda, CPA Rwanda. And I also hold a Bachelor of Science degree in economics of Makerere University. And of course, with a lot of other physical trainings in-house, out of the country, during my tenure in URA as well as EY. And I have with me a very strong team of experts as well. These are also tax experts. And on my immediate right is Alan Mugisha. Alan Mugisha has also had a very mixed experience, Uganda Revenue Authority, industry, as well as coming back to EY for a couple of years. And I request him to greet our audience and introduce him, just your name, your experience, and the professional experience. Then I go to the next one. Alan, over to you.
I'm Alan Mujisha. Like is indicated, I hold a number of trainings, both undergraduate. I did economics, postgraduate. Did a postgraduate diploma in revenue and tax administration. Subsequently, I did an MBA. But I've had a couple of varied experience across the industry, across different clients, both in the other big four, in URA, and currently with EY. I've got an experience of over 26 years of experience. Thank you, and I look forward to sharing with you my experience and thoughts. Thank you.
Thanks, Alan. He just missed out. He's also a fellow of ACCA. He's a chartered accountant as well as certified public accountant of Uganda. Thanks, Alan. My immediate right after Alan is Prosper Ahabwe. He's also an associate director. Alan is an associate partner in Ernst & Young. And Prosper is associate director. Prosper, greet our audience and indicate to them who you are and your experience.
Good morning, everybody. Prosper Hawe is my name. I am an associate director with Ernst & Young. I'm excited to be a part of this panel and really appreciate you for taking time to listen to us today. I am an ACCA, a fellow with NCCA. I am a CPA as well. I hold an advanced diploma in international tax with the Chartered Tax Advisors for the UK. I also hold a master's degree in business administration from Heriot University. And I am a chartered accountant and also hold a bachelor's degree in commerce. I have 18 years experience in the tax field, 16 of which have been at EY, and about 2.5 where I manage the domestic taxes of Warri Telecom. My experience varies in tax compliance, in tax advisory, transfer pricing, and different other services that we offer. So thank you. I'm really, really privileged to be here. Looking forward to sharing our thoughts and perspectives with you. Thank you.
Thanks, Prosper. He's also, as you can see, many of the tax practitioners also have a link in the accounting field because taxation is generally law and facts. Facts are the numbers. So you must have a firm grip on the numbers on which you apply the law. So most of my team have some bias towards accounting. Then on my extreme right is Robert Mbazira. He's also going to be part of this discussion. Mbazira, can you greet the audience and probably give them a brief introduction of your profile?
Thank you, Mohammed, and a very good morning to you all. Where I'm seated, it is actually a cold morning. It has rained this morning. But by way of introduction, my name is Robert Mbazira. I'm a senior tax manager at Ernst & Young. I've been with the firm for over 12 years. I'm born and bred from EY, I joined EY straight from campus. So all my experience just now have been advising taxpayers. I look forward to this discussion. I'm a chartered accountant. I also hold a diploma in accounting from UK, but from a degree perspective, I hold a bachelor's of degree in economics from Makerere University. I look forward to this discussion. Thank you, Mohammed.
Thank you, my panelists. As we progress, for those attending online, you can always link up, open your link, put comments, put questions. My people are going to make their presentations, they share their insights. Then we shall have some spare time to respond to some of those questions and comments. And without making further ado, I request Alan to touch on the broader budget issues. But you know, Alan, as you know, generally, we are looking at 2024, 2025. But it would be good for the viewers to appreciate, even if it's at high level, what was the 2023-24 budget in terms of broader perspective, and maybe a certain level of assessment so far. How has been that budget performance in terms of expenditure as well as revenue? Maybe you can start with that point, Alan.
Thank you, Muhammad. The current financial year, the budget was 52 trillion. And of that figure, around 29 trillion was supposed to be domestically mobilized from both the revenue authority and the non-tax revenue from the various government agencies, amounting to 29 trillion. And the balance between the 29 and the 52 was definitely through borrowing and some elements of government refinancing of some of the existing loans. Where we stand now, given the latest statistics, the indications are that as of March, Uganda Revenue Authority had collected around 17 trillion out of the 27 trillion they need to correct. The remaining few months between then and end of June, they are expected to correct the balance. Where we stand, we know that they are lagging behind in terms of their performance, and we hope that some miracles can happen in the remaining 1.5 months to 30th June. When it comes to expenditure, again, this year we've seen a number of government projects being implemented. However, overall, I think there's been a general big problem when it comes to project implementation. I think government is not good at implementing some of the projects, but we've also had some challenges around leakages out of the planned expenditure, and as we've seen, also we've also had some pushback from the trading community, basically saying, government, you're asking us as the private sector to tighten our belt, but government, you continue to spend, and some of the expenditures are out of the norm, and while others, you still remain with some corruption challenges. And I think the last few months we've seen, and weeks we've seen some traders going on strike, much as the main challenge was EFRIS, but probably there are also underlying other issues in relation to government efficiency, how they spend, as well as competition with some of the foreign investors. Thank you.
Okay, I think on that point, thanks, Alan. On that point, when you say that the key revenue resource for government is tax revenue, and it's lagging behind by a whopping 12 trillion as of March, because they are at 17 as opposed to compared to 29 annual target. And looking at that, and of course, I want also to remind you and the viewers that at the very beginning of this year, we had some, I call it friction, with some of the foreign donors based on some laws they didn't like. And our and our donor funding was negatively impacted, of course reducing the government envelope. Have we seen government expenditure responding the same way, maybe by reducing the budget expenditure, or I've seen quite a number of supplementary budgets coming in, and I don't see, there is a misalignment. I see resources are becoming slimmer, yet the expenditure is expanding. How can you equate that and analyze it from your perspective to the viewers?
Yeah, thank you, Mohammed. I think, again, it talks to what the private sector is calling on government. While we ask the private sector to tighten their belt and increase their tax contribution, the private sector is also basically saying government also reduce some of the expenditures in line with the resource envelope that we have as a country, which is unlikely to change given the challenges you've highlighted. Some of the project finance that was meant to come in didn't come in. Some of the financing was also adversely impacted by the new laws that we had. Some of the funders were not happy. So we basically need to call on to government to increase their efficiency the way with the small resource envelope they have, the small funds they have collected, to basically ensure that they have the highest level of efficiency and apply it to develop this country.
Okay, thanks. Let's now tune our attention to the coming year, 2024-2025. What is in for us as far as the budget is concerned, and as well as the revenue sources? What's the envelope we are looking for in the next financial year?
Yeah, thank you. Again, the ballpark figure we have is 58.34 trillion as the budget which was presented before the parliament. But even on the onset, as the minister presented it, he had a number of budget cuts, including parliament itself and some other lines of government like judiciary, and there is already a big fight around how the 58 is going to be, or it should be allocated. All we basically do understand that they are in the kitchen. It was referred to the Committee of Finance of Parliament, and there are some areas they are scrutinizing and also engaging with the Minister of Finance. However, all we basically know that, again, like in line with the previous years, the biggest portion of the 58.34 trillion is going to go towards debt and interest payments. So which basically means that when it comes to actual allocation to recurrent and development expenditure, it will only be a figure of less than around 64 to around 66%, because the bulk of it goes to areas which government has no control. And the only way government can have control on some of the debt and debt repayments will basically be to come up with some of the refinancing arrangements on some of those loans, also alternatively rolling over some of the public debts through some engagement through Bank of Uganda. Again, it's a big challenge that we are basically dealing with. However, also in terms of project finance and donor support, not so much has changed from the current financial year, so don't expect a lot of funds to come in. The only savior that we'll definitely have will basically be oil and gas, but we don't expect the first oil to come in until sometime in 2025. So for the time being, we are moving in a tight corner, and yet government needs some of the infrastructure and some of the expenditures to run the country. Thank you.
Yeah, on that same point, when you are looking at the overall picture, Last year, it was 52 trillion. And for the reasons already highlighted, even that figure was not achieved. But what's the magic now of increasing that earlier budget by about 12 to 13% to 58? Where is the magic going to come from? What's your take on that?
Yeah.
Because it doesn't really add up from a layman's perspective. 52 was difficult to achieve. Have the conditions changed? What has changed? What is going to be different this year to justify that huge increment?
Yeah, thank you. From the analysis basically had at a high level is that definitely government wants to spend more on some of the infrastructure projects, and hence we foresee increased borrowing to fund the gap that that the government has. But also, there is an element that government is foreseeing that come 2025, will have oil, and hence they'll basically be able to repay some of, get some additional financing for some of the projects. So they could basically be borrowing ahead of anticipated revenue in 2025.
Okay, I think I just want to end, in the interest of time, with one comment on the borrowing, because ideally private sector has been complaining, and actually in my view rightly so, that when government goes to the private sector, to the banks, and borrows, government borrows by selling its instruments, treasury bills, treasury bonds, and they are the safest instrument. In the financial institution will go for, there is no risk, there is no failure, everybody is getting a clear cut, even there are no overheads. And the financial institutions have been going for it. So they've been actually preferring to lend government as opposed to private sector. And private sector has no finance to move the economy. So the economy is really getting crippled. How does that one, how do we get out of that? I think it's a net which we can't break. And if government is actually hoping that it's going to recover that budget increment gap through additional private borrowing, do we see private sector suffocating further this year? What's your take?
Yeah, thank you. From the even from the Ministry of Finance and the government, they are cognizant of that fact, and it's a right complaint. So what we basically foresee that government would want to limit borrowing from local market to a smaller component, and instead go for concessional loans and external borrowing. But as you basically appreciate that some of these borrowings take some bit of time, so in the interim we could basically run a potential risk of government falling back on its promise and continuing to borrow from the local market as they wait long-term and concessional borrowing from external sources.
Okay, thanks. For now, I'll move to Prosper. But before I move to Prosper, I think for the viewers, you can really appreciate we are between a rock and a hard place. Government is really wanting to even develop good infrastructure projects, which are good for the economy, but in the medium, short term, they are having probably a knock-on effect to the private sector, and maybe we still have some, maybe 1-2 years until we can actually see that oil bullet coming out. We are still about to continue into, and actually that's why you see the finance sector in terms of cost of borrowing, even the little money which is available to private sector, the cost is so huge because the banks can afford to ignore. If you don't want it at that cost, we have our government, and they don't default. So now it's actually reaching 22% annual interest. So even if private sector can afford it, I mean can access it, the cost is too high. So I think everybody really needs to guess what the impact is. Your guess is as good as mine, but we thanks Alan, and of course put your comments in the link. We shall look at them. I want to move on for now to Prosper. Prosper, as you have heard, 29 trillion is the target for revenue for 2023-2024. And I'm sure 2025 is not going to reduce. How do you see, in view of the probably, maybe just first take the viewers into the new tax amendments, maybe they can appreciate whether they'll be robust enough to cover that revenue gap, then we can probably look at what comes up. So I request you look through, maybe it may not be all, but the ones you see which are more relevant, which may have maybe bigger impact, touch on the amendments in the value added tax. Value added tax is a huge tax because it's actually on consumption, and it's a huge percentage, 18%. Whether somebody is hiding in Ichotera or in Kabulamaido, when he goes and buys that sugar, he's paying 18%, irrespective of his income. So it's something you really need to look at. What are the changes coming out in the value added tax? And also, you may also touch also on excise duty. But as you finish that, there is this animal called the EFRIS. Let our viewers understand what is this animal called the EFRIS. All the traders have been even rioting, closing their shops. They had discussion with the president. The EFRIS animal still looks to be alive. You'll touch on it so that our viewers understand it. Is it a new tax? What is this animal called the EFRIS? But first start with the amendments on the VAT and some of the excise duty amendments, touch on EFRIS, then we can pick it from there.
Thank you very much, Mohammed. And thank you very much. Thank you very much, Mohammed and Alan, for shedding that background behind the budget and the need for funding for the budget. That in and of itself implies that government has got to focus a lot on raising domestic revenue. And measures have been put in place through the bills that have been proposed for VAT, for excise duty, income tax, and others to raise funding. Those bills are actually hope to raise at least 1.9 trillion in additional government revenue from taxes. So there are a number of measures that have come through, and I can touch a bit on some of them. Particularly, I'll start with excise duty. We're seeing that where there is reconstitution of powdered beer has now come into the excise duty schedule in order to be taxed at 2,500 shillings per kilo. What that means is that they're expanding the base, because we're used to beers which are always liquid form, and now this one was out of the scope of taxation for excise duty. So 2,500 is not a small amount per kilo, and it's hoped to raise additional government revenue as well. This is likely to impact brands like Chibuku, which are in the market, and those who enjoy these drinks get ready to pay a little more in terms of price, because indirect taxes, the way they work is that the cost of the tax is embedded in the price, and you do not get to feel it as you buy the product. You indirectly paying it, but you don't end up feeling it, because you're enjoying what you're paying for on the other hand. So I think it's an easy way for government to collect taxes, and government is focusing more on indirect taxes in order to grow its domestic revenue. Also, we're seeing that on the cement, the area of cement, adhesives, grout, and other white cement, lime, is coming in to be taxed. We already had cement, but the list is expanding. So those in the construction sector and those who are constructing, you're going to pay a little more, 500 shillings per 50 kg of grout, of adhesives, of white cement. That is being captured. So, and this is for the construction sector. I think what touches on all of us is the transport. Gasoline, gas oil, which is petrol and diesel. for the past 3 years, there has not been an increase in this area. And we know why, because there was COVID. After that, we had the shocks from the Ukraine-Russia conflict, which led to a disruption in the supply chain for petroleum products. But now government is touching on this again. And 100 shillings has been increased on the excise duty that is within a liter, to be paid within a liter of petrol. So now we will pay 1,450 per, from 1,450 to 1,550 per liter. Also, diesel from 1,130 to 1,230 per liter. Mind you, the overall percentage of this tax to the pump price is significant. For petrol, around 28%. So each time you buy a liter of petrol at 5,000 or 5,500, you are paying 1,550 to government. So these are again going to increase the costs of transport. Transport is important, is an important factor in production, in transporting raw materials, transporting finished products, and basically all these costs will then be passed on to the final consumer. That is you and me. Kerosene is also being subjected to tax at a very substantial increase from just 200 to 300 to 500. Yeah, this is a very, very big increase for especially Omuntu wa wansi, the people who are still waiting for electricity to reach their villages, who can't afford solar. They are still running on kerosene. So this kind of increase may deter the spend of them, and they may have to dig deeper from their very little resources to get more of that. I think the other area which we see, and more of an alignment, is the payment systems. Payment systems, where you withdraw cash from payment systems providers. This will then attract a 0.5% on the value of the withdrawal. So this is aligning it with what we already have on the mobile money side, where when you withdraw mobile money, you have to pay 0.5% from the mobile money side. Now the banking sector moved in, and through agents is also bring financial services closer to the people. And I can see that from this kind of measure, even the one on mobile money is almost as though you're taxing money instead of an economic activity. So it's important for government to align its tax policy in such a way that it does not discourage the uptake, because these services are bringing banking closer to the lower person, to the person in the village who otherwise would have not had banking facilities brought to them. We think that these measures should, in a way, not be implemented, this particular measure, to allow the expansion of the financial services and then savings as well. So this is what I want to highlight from a perspective of excise duty. On the VAT side, we have seen not so many changes. Some are simple clarifications around supplies that are made through auction. We had an amendment the previous year where a supply made by an auction was deemed to be the supply of the auctioneer. And then the auctioneer was then required to account for VAT on that. But that was problematic because the auctioneer would not have input VAT since they didn't purchase that say asset that they are selling. It was distorting the VAT system. So the amendment that is coming is that to the effect that now the recipient of the proceeds from an auction will be deemed to have made a supply, and will be the one who should account for VAT on that supply. That, in a way, more aligns it to uh, the system of VAT, but we also need to understand who the recipient is. Who are the people who use auction services? The banks, when they're auctioning the securities, and others. So is the recipient the bank, or is the recipient the borrower who defaulted? This clarification needs to come out as well. Um, in addition, a supply that is made by the employer to the employee for no consideration has been classified and categorized as a taxable supply. What that implies is that the employer would have to account for VAT at 18% on that supply. Already, we have a provision for application to own use, where an employer or someone who is providing a service uses that supply for their own business. They are deemed to have made a supply, and they account for that. So this one seems to target where an employer perhaps gifts what they are producing to their employee. For example, you are a beverage company and you provide beverages. During Christmas season, you decide to give out as gifts to crates of soda, as gifts to your employees. That is now going to fully be captured, because in the previous law, it appears that was not very refined, that it's an application to own use. The businesses could argue that, no, that was a gift, it wasn't for use in my business. So this clarification is welcome, and is going to result into that effect. We have also a welcome amendment to increase the threshold for offsetting input VAT, where your input VAT exceeds your output VAT. The input VAT is VAT on your purchases, exceeds the VAT on your sales. You can claim as an offset, or you can claim for a refund. Now, the limit has been 5 million shillings, that you can only offset 5 million shillings automatically. Any other offset of excess of input over output had to require consent from the commissioner. So they're increasing this threshold to 10 million shillings. This is welcome. I think it would have been even bigger, because 10 million is quite a small value. It should have gone at least to 50 million shillings. However, for the small businesses whose turnover is low, I think they'll be compelled to have to get refunds earlier. So big businesses can stomach it if it's increased, but the small businesses would have to get refunds earlier. So this is good for them. We see that withholding VAT was introduced in our Act. And now the amendment that we are seeing is to ensure that there is some sort of consequence if a VAT withholding agent does not go ahead and withhold VAT. So this is similar to what is in the Income Tax Act, where now they are being required, they will be obligated to incur that withholding tax as their own. However, they could go ahead and get a refund or reclaim it from the person who they ought to have withheld from. So this is a compelling provision, and it's also welcome. Overall, from a exemption versus zero-rated supplies or taxable supplies, what is happening on that front? We can see that, say, hose, pesticides, fertilizers, seedlings are being removed from the zero-rated schedule and being made exempt. That in and of itself may seem innocent, but it has an effect. Zero-rated supply has zero effect. VAT has zero effect on its price from the production to the consumer. But an exempt supply, the VAT that the producer incurs cannot be refunded or claimed. So it becomes a cost to that business, which they'll pass on as well. So this, I think, given that we are focusing on agriculture as a country, and it is employing about 68% of Ugandans, we should see how to subsidize the cost of these implements as much as possible, so that it's not a burden to the sector. Mohammed, you asked about EFRIS and what it is. This is, I can touch on this a bit, because EFRIS is simply government's smart business solution to track records of taxpayers, to assist in invoicing, e-invoicing. It can help to maintain the records, since the records will not get lost, and also assist in expediting refunds and claims that a taxpayer may have once they have onboarded in EFRIS. Different options are available under EFRIS, that is a system-to-system integration. A taxpayer's billing system can be integrated with URA's EFRIS system, and automatically, as they raise invoices in their billing system, they are transmitted to the Revenue Authority. Then there are other options like the web portal option. If your transactions are not many, you can have the web portal option also. There are USSD options. There is the mobile application option that for offline mode as well. So EFRIS in and of itself is a tool that can be used to in tax administration, and it will help maintain a record of the business transactions of a taxpayer.
Thanks, Prosper, for that very elaborate presentation on the new taxes provisions in VAT and excise duty. And on EFRIS, you clarified that it's not a new tax, but just a method of URA tracking transactions. But when you look at the implementation of EFRIS, could it have been probably done better, especially when you look at the traders, when they say the penalties are too high for the small traders? Missing a transaction which you should have invoiced via EFRIS, whether the transaction is 500,000, the penalty is 6 million. Is it practical? Does it really work? I really want us to understand. Should it have been taken probably in a phased way? For big companies, maybe threshold of say 2 billion.
Yes.
Then you now probably over another 2 years you scale it down maybe to 1 billion, like that. Because for definitely the big companies, you know, even most of our clients, they actually needed our support in EFRIS implementation. They could afford to hire our services, and actually we even put in quite a lot of effort, even us to learn it, so that we can advise our clients. But does it apply to everybody? Mind you, the VAT threshold registration is just 150 million. 150 million, when you hear it, that's an annual threshold. You think it's not. When you divide it by 12 months, it's just about 12.5. On a daily basis, it's just about 100,000 sales. And gross sales, that's where the VAT starts applying. Do you want to apply EFRIS at that level, or we should have actually probably phased it depending on threshold? And the penalty bit looks quite punitive.
Yes, Mohammed, thank you. The penalty is really, really punitive, because for each cash receipt that you have not issued in EFRIS and yet you owe to issue it, you have this 6 million that you have to pay. That can definitely cripple a business. Yeah, no one, the small businesses especially with those low thresholds of 150 million can actually be crippled by this hefty penalty. Yes, the implementation of EFRIS needed to go through a certain process, a phased process, so that it is scaled downwards through the whole distribution chain. Because if you go to the grassroots to implement EFRIS, when in the middle of the distribution chain they are not implementing EFRIS, then the grassroots level will suffer the VAT as a cost to them, and they can't claim it back. And I think this is one of the concerns that the traders had or have, that they feel they are paying tax on tax. So it has to work all through. If the import has suffered VAT, the person who imported should be with EFRIS. If they go ahead and distribute that import to a distributor, the distributor should have EFRIS, and then downwards. I think another issue that they had was around the cash sales, where cash passing credit sales, and if they made a credit sale, what happens? The VAT law provides for a threshold for someone to account for cash sales. If you don't have a turnover, if your turnover does not exceed 500 million annually, you could elect to use a cash-based accounting method with the commissioner, and then that becomes your process. Otherwise, EFRIS doesn't know whether you've sold on cash or you've sold on credit, and the VAT provisions allow for both methods. So I think we'd advise traders, those who are below that threshold of 500, to go ahead and elect to do cash-based accounting. I think the other area, Mohammed, around the implementation, apart from the penalties, was the seizure of goods that were going without EFRIS receipts. And I think that approach was very, very punitive on the traders. It made them lose a lot of business. I think URA may need to balance between the enforcement measures and business survival, that the businesses need to survive first. Otherwise, you may end up killing the cow that you intend to milk.
Thank you, Prosper. Time is running, it's enjoyable, but we have to move on. Now, Robert.
Yes, Mohammed.
How are you today?
Very well, thanks.
Ready for my audience?
Yes. Please
Now,
shoot.
why don't you start with sharing the amendments on income tax? Then after you have shared the amendments on income tax, then probably you can touch on the amendments in the Tax Procedures Code Act. Then probably so that our audience can get a feel how is their income going to be impacted under the new law if this bill become law come 1st July.
Okay. So thank you, Mohammed, and good morning once again, viewers. Maybe before I get to the amendments that are being proposed from the income tax angle and later in the Tax Procedures Code Act, allow me first provide some perspective by looking at what government has been doing in the recent years post-COVID around the same acts. If you can recall, in the previous year, in the income tax bill, which later became acts, government was actually, it repealed initial allowance, which was a capital allowance. So in a way, some incentives were being taken away. Mind you, that incentive was to encourage investors to invest outside Kampala. 50 kilometers away from Kampala, you'd be given a 50% on the cost incurred on the machinery and others. And now this year, what government, in my view, what government has actually done, it comes in to introduce new taxes. Post-COVID, there were no new taxes being introduced. Now, this year come 2024, 2025, From my analysis, I'm seeing government introducing new taxes. A case in point is when you look at the Income Tax Act, there is this famous amendment which everyone, the proposal which everyone has been talking about. And that is around withholding tax on gains that you would have earned from disposal of non-business assets. And one of them at 5%, this would be a final tax. So some of you have been following closely what parliamentarians have been discussing and the general public. You might have had everyone go against it. Why? Remember here they are saying non-business assets where withholding tax would be applicable are 1, land in cities and municipalities. That is 1. 2, shares that you would have in a private company. Then number 3 is about rented properties. I'm not so sure whether, and I know most of you, the viewers, especially those who have grown in age, you have rental properties. And here they are saying the rented properties would be considered to be non-business assets. The land that you and me have, so long as it is in a city or a municipality, when you decide to sell it off, there would be withholding tax at 5%. This is not a new amendment, ladies and gentlemen. Mind you, in 2020, government attempted to bring the same amendment, but then it was on proceeds, the selling price. Last year, government did the same, but there was a backlash and it was withdrawn or deleted. Now, this year, it is again back. I'm tempted to think if it doesn't go through this, probably next year, it could go through. For your information, when it comes to land, government has targeted cities and municipalities. I don't know for you, Mohammed. I know in the past people were demanding the president to have state status. President said, it is okay. I'll grant you the city status. Municipalities were coming up. Now, government is saying, you know what, if you have land in those cities or municipalities, I'm going to tax you when you dispose of that land. Okay? So the first issue is about location. The quick question that I could probably raise is, doesn't it mean that that land which is in the other districts, for information based on the local government data in 2020, we had around 146 districts, around 31 municipalities, and 11 cities. So 31 municipalities, 11 cities are the target. But remember the 146 districts. That already means that there would be districts which would be out of scope, that land. Could we be seeing people buying more land the other side? And in any case, if Mohammed was excited that his district, his area had been granted state status and he wanted to invest, now, this withholding tax that has been introduced could most likely make land much more expensive, which in a way could impact on economic activity. It is also possible that probably what government is trying to do, it is saying, you know what, when I gave you city status, the expenditure had to increase. Now I've got to find sources of revenue in order to ensure that I'm able to fund your budget for the city. Probably that could be the reason as to why government is targeting cities and municipalities. But there is something also interesting that I would want to share with you viewers. And this is around the land tenure system. When you look at Uganda, we have our land tenure system, we have 4 main types. We have got customary, which is common in the north, and probably other areas. We have got Milo, common here in the central. There is also freehold and leasehold, which could happen across. The key question is, when you look at those 4 types of the land tenure system, I'm tempted to think, while this amendment was being brought up, probably they did not look into the detail of the land tenure system. For example, when I lease my land to Prosper, have I sold? Remember, leasehold, you are not holding it in perpetuity. What would happen if Prosper decides to renew the lease? Would I also be paying tax on the renewal? So some of those are not yet so clear, or they didn't come out clearly. I'm interested to hear what parliamentarians have discussed around this. But then also, the other one, which is quite interesting, is around the customary, which is common in the north. When you look at the north, they've actually, you remember very well that they were hit so hard with the Coney War. And when it comes to customary, land is owned at a communal level. If that is the case, then remember, and at the communal level, you find that how you are able to determine the demarcations, some of them actually, others were using trees. So with the impact of the war, are you sure you'll be able to determine where someone's demarcation of the land? And if it so happens, remember it is owned communally. If Mohammed disposes of that land, but Robert is also claiming it, is also among the owners. So how are you going to be able to determine the ultimate beneficiary? Because this specific amendment is targeting the seller. Okay? It's the one who would be, ordinarily they are saying, you the buyer, as you pay the seller, withhold, communicate to the revenue authority, and ensure that that tax is paid within 15 days. So there are some ambiguities within the law. And then for rental properties, which they're also being considered among non-business assets. For example, if Mohammed has rental properties and is already paying rental tax, but then you are saying these rentals, the moment you dispose them off, the gain on disposal, please, 5% should be suffered. Number one is, remember, already, if Mohammed was in that business, there would be capital gains tax. Okay? Which ordinarily would be accounted for. Now, I don't know what really government is focusing on. Is it that they are focusing on rental properties that are owned by, for example, Ronald Amega, who is a non-business person? There are so many ambiguities in the law which I would be interested to look at. The other is about, they say, for your information, that the land that has been disposed of in cities will not include your principal place of residence. Now, to my moderator, Haji Sempija, you could find that in a year, one Hajat, half, 6 months. The other Hajat, half. So how are you going to determine his principal place of residence? Are you going to say 1 or 2? So there are so many anomalies that someone would have to look at before you probably come up to implement this. But interestingly so, there is also, some of us actually own land, you and me, even you the journalists in this room this morning in the studio. It could be that probably you inherited land, and because now you are employed with NTV, NBS, UBC, Bukede, you want to come in and say, you know what? Because I've earned some income, let me go and make this land productive. The key question that then arises, remember you're trying to convert it. Probably you're transferring it from the names of the administrators to you. And the question here is that, into your names, the question here is that as you convert from non-business to business use, would that be considered to be a disposal? For your information, in the Income Tax Act, I will not get into the quoting the sections, but they go ahead to define what a disposal is. You have sold, you have redeemed, you have, it has been destroyed, so, or you have given it out as a gift. It is a disposal. Now, the key question here would be that this conversion, is it actually a disposal? Probably that under the current law, already there is an exemption to that. But with the new amendment, it means that even that conversion, you would have to pay the withholding tax, the 5%. And then finally, as I move away from that amendment, is the dilemma on verifying the cost base. Remember, in arriving at the gain, principally, even to an ordinary Ugandan, for you to say, this is my profit, you'd have to get your selling price, you less the cost. So even when it comes to that land, you would do the same. You would get your selling price, you less the cost. And one of the things in the current law, where someone is disposing of under the capital gains regime, they take into consideration the aspect of inflation. They index the cost base. And in this case, with the new amendment, all that is not being considered, which is already a privilege to someone who was disposing of business assets. So that is an interesting proposal that is coming in, and we wait to see how it's going to impact, but the biggest impact is actually on the real estate. The other amendment, which interestingly, it has not attracted a lot of noise, but I feel it is, the impact could be enormous, is around withholding tax on interest on debentures. Previously, the withholding tax has been exempt. Ladies and gentlemen, all of you who are following me live, you will note that in the current law, if, for example, Mohammed went outside and he got a loan from a non-resident in form of a debenture, it would, while he pays the interest, that interest would be exempt, so long as it is widely issued. In the current law that is coming up, it is changing. They are saying, if you get a loan from the non-resident, a debenture, in this case, withholding tax would be paid at 2% as you pay the non-resident. So long as, key to note, so long as the non-resident you are paying, one, is a financial institution. Two, if it is a financial institution, they are not in any way related. Otherwise, if they are related, the standard withholding tax rate of 15% would come in. And where applicable, the double tax agreements reduced rate would apply. Now, where is the key risk that I see probably others have not yet seen? And that's why I'm here to tell you this morning. One of them is that when you look at Uganda generally, most of the people that have been benefiting from this are either those who are participating in the public-private partnerships, funding big infrastructure projects. They usually go in to benefit by borrowing from non-residents. The others are banks, financial institutions here. But allow me paint a picture for you when it comes to Uganda's, when it comes to the financial sector. When you look at the financial sector, the top 10 banks, for your information, are foreign-owned banks. They have their relatives abroad. The likes of Stanbic, Absa, Stanchart. You could mention, the list is endless. What here they are saying, remember the key for the exemption for you to use the 2% is that you should not be related. So here they are basically telling you that use Stanbic if you borrow from Standard Bank South Africa, while you are paying them because you're already related. Remember, Stanbic is borrowing to lend to Robert. Stanbic, they are telling them before there was no withholding tax. So Standard Bank South Africa was getting clean money. Now, here they are saying, because you're related, 15%, otherwise use the reduced rate. Because we have a tax agreement with South Africa. So now, what is the impact? The impact is that, what I anticipate, Mohammed, is that most likely there's going to be a ripple effect in the interest rate. But then also, the other exemption that comes in under this new proposal is that government is saying, you foreigner, when you lend to me, please note, there would be no withholding tax. Others, 2%, but if you are related, 15%. What does this mean? Remember, some of these foreign banks, for your information, they have been lending to the local banks, and the local banks probably invest in government securities, which is now domestic borrowing. So when government says, when you lend me as government, no withholding tax, Indirect government is saying, you foreigner, come and invest in my government securities. Okay? That is number one. But then, but remember, the foreigners have been lending to the local banks. Number two, it is possible that this withholding tax that is being introduced would, in a way, make our country less attractive capital. Because we know there are jurisdictions where probably this does not apply. But then also it is key for us to look at where government is trying to come from. Following the international tax principles, if income is earned from Uganda, Standard Bank South Africa, if it lent to Stanbic Uganda, Standard Bank would have earned income through interest from Uganda, which means that the international laws allow Uganda to first tax that interest that has been earned by the Standard Bank South Africa, which we have not been doing. Now, because we have not been doing that, when the Standard Bank takes back the interest to South Africa would say, oh, welcome back from Uganda with this basket of money. And South Africa would tax that interest, which Uganda didn't tax, which means that government in a way is losing. Because it didn't tax that, another country has run very fast and have taken over the right to tax it. So it is also imperative for us to, when it comes to this amendment, to try and appreciate where government is trying to come from. But my ask to the government is try to look for that balance, because we are a less developing country and we would want to attract investment. So when you do so and you limit the capital that is coming in, it could probably impact also on the taxes that you would collect, which Alan did talk about. The list could be endless, Mohammed. There is also the tax waiver, which is not new. It was there last year. And you, the taxpayers, this is also another avenue for you to probably try and comply, because when you take advantage of this waiver is saying that if you have any taxes that are due or would be due by 30th June 2024, and you have them paid by 31st December 2024, you would take advantage. They would forgive you the interest and the penalties. And you very well remember that last year adverts were being run on TV, radios, and so many taxpayers actually did take advantage of this. But then also there was an issue when it came to the tax ledgers. They were paying, but they were not seeing the interest being waived. So that is one of the challenges, and it continues to be a challenge. Mohammed, you will allow me pause there for income tax. I know there are so many interesting amendments, but for purposes of time, I may not be able to go through all of them.
Quickly,
yes.
Through the tax procedures code.
The tax procedures.
Summarize, please, quickly.
Okay,
So
the tax procedures code. There is only one amendment, and the tax procedures code is basically more around administration, and there is only one amendment which is around destruction of goods. That before you destroy your goods, either they have been damaged, they are outdated, expired, sorry, you have got to, before you destroy them, before they were inviting authorities like NEMA, and now the URA is saying, before you destroy them, please, let me be there. They're now putting it in law. Let me be there to see, and I give you the certificate. There is an implication here. We know very well that in the books of businesses, usually there are things like write-offs, because when you destroy them, that is a loss. When you write off going forward, if this goes through, most likely URA is going to be interested in looking at the certificates, because now it is within the law. Thank you, Mohammed.
Many thanks, Robert. And of course, I want to thank the viewers who have actually been very active online. I have some comments and some questions for my panelists, and depending on the subject you have handled, you will deal the question. We have Brian Natulinda. Please, can you throw more light on the VAT deemed on the gift to the employees? The question is, what happens to the company if the items are in the categories of exempt or zero rated, like fertilizer or flour? Can you deal with that, probably, Prosper?
Thank you very much for that question. And I think you raise a very pertinent question around if the supplies are actually exempt under the VAT Act, and you go ahead and as an employer, you pass them on to an employee, what would happen in terms of VAT treatment. So what the law is actually saying is that that would be a taxable supply. But then you're also going to see that it's conflicting with the exempt supplies schedule on in the second schedule of the VAT Act. So, and if it's exempt, exempt should take precedence over the taxable nature, because VAT is transaction based, and you have to look at the actual supply to determine first whether it's exempt. If it's not exempt, it's automatically taxable. So in this case, since the fertilizers and pesticides are exempt, then they should take precedence as exempt supply. Thank you.
Yeah, also
Brian.
to add that general tax principle in terms of law, the treatment is where there is a specific provision of law talking about an item, that specific provision overrides the general provision. So this amendment is general. When you say it's a taxable supply, then you go to the VAT law itself and says, oh, fertilizer is actually exempt. Because it's specific on fertilizer, that provision overrides the general provision. So the second one also by Brian Natulinda, same to on VAT Prosper. Does the VAT amendment also apply to the donation made by companies, individuals, or only companies? That donation, it must be, I think, relating to the same question. The donation given to, the gift given to employees.
Okay.
Does it apply only for companies or even?
All right. Thank you very much for that question, Brian. Actually, the way the law is worded, it talks about employer. So an employer can be any person, and a person can include a company, a partnership, a trust. It can even include an individual. You can employ somebody, you as an individual, who is in business as a sole trader. So if effectively, it will capture both companies and individuals, to be precise. Thanks.
Thanks, Prosper. Very precise, and I hope, Brian, you are comfortable with those responses. Now we go to the next question. Tusubira Nina, my company imports and resells greenhouses to farmers. My question is, how will this tax amendment affect me as I carry on my business in terms of taxes at the point of importing and when I sell to local? So they import greenhouses and resell them to farmers. So how do these amendments, how will they impact? I think this is a general one. Ideally, when you are in company, import and resell business, you have to look at the nature of the goods you are dealing with. And from a VAT perspective, you are making supplies because you are in business and it's regular. First, you have to first determine greenhouses. Are they VAT exempt? No. Are they exempt? No. Taxable is the default. So then they are taxable. The second question, if they are taxable, does your turnover reach the minimum threshold of 150 million? Yes or no? If yes, even before the amendment, because the amendment has not even touched on the threshold, the threshold remains 150 million. So if your sales, the import and sale, your sales value in gross terms equals 150 million or above, you are already entitled, you are already obliged to register for VAT. The obligation to register for VAT, or you already crossed it when you reached, actually even the law they talk about 30 7.5 million per quarter. They break the 150 million into 4 quarters. So you are already probably having an obligation. And if you have an obligation to register for VAT and you did not register when you triggered that obligation, the VAT law takes you as if you are VAT registered from the date that duty arose, meaning that all the sales you've been making over these years since you reached 150 million, the taxman, when he comes, they will say, okay, you are already VAT, you should have registered for VAT. So these sales, whatever you sold, 18% should have been VAT, give it to us. So I think my advice, look for an advisor, get somebody who knows these technical issues. They look at your detail, then they can advise you clearly where you actually due for VAT registration. Then they can advise you how you can deal with going forward. The last one so far, we still have time. The last one so far is from Mario Mulekezi. Thanks for the discussion. A question to the team. Is the penalty for failure to issue an e-invoice per month or per invoice not issued? Is there any case law that guided on the same? I think they are referring to the EFRIS. I want to direct this to Prosper. Is the penalty per transaction or per period, monthly?
Yeah, the penalty would actually be per transaction. It's not a monthly penalty, it's a transaction-based penalty. And this is what really makes it very, very high and punitive. And the president also listened to the plea of the traders and directed that these penalties be waived for those who were not sensitized and were not aware about onboarding EFRIS. So I think it is actually a per transaction thing, and one would have to avoid it as much as possible. Thank you.
Actually, that's why the outcry is really huge, because it's per transaction. Whether the transaction is 500,000, like I said, the penalty is 6 million. So which is quite punitive. I think the last one I'll ask, this is coming from the question from Joshua Makuyi. What changes have been proposed under the Stamp Duty Act? Of course, we did not touch stamp duty, but any of my panelists, Prosper, had it, but we thought the more significant ones were the initial we've discussed. But probably, Prosper, if you can just touch on it, high level, the key areas, so that we can address Makui's question. So
Okay,
Prosper,
thank you
over
for
to
that. There were not very many changes within the Stamp Duty Act. The ones that we saw were actually targeted at exempting the investors who invest through private equity and joint venture funds, which are registered by and regulated under Capital Markets Authority. So the nominal share capital that is being registered, or an increase of that nominal share capital, will not attract 0.5% duty if you are in that category of a private equity fund or a joint venture fund. So this is a very welcome amendment to encourage investment through these vehicles. In addition to that, the manufacturers of electric vehicles, electric batteries, or electric vehicle charging equipment, all the fabricators of bodies of these kinds of electric vehicles, when they invest the minimum threshold investment of about 10 million US dollars if they are foreign, or 300,000 US dollars if they are citizens, that means East African citizens of any state of East Africa, and have certain other criteria that they have to follow in terms of local content, they are going to be exempt on the mortgages, debentures, whether they are for mortgages or non-mortgages. They are going to be exempt on instruments of leases of land, They're going to be exempt on increase in share capital as well and transfer of land. So they will not be captured under stamp duty for this in these schedules of the second schedule of the VAT of the Stamp Duty Act. Thank you.
Thank you so much. We hope we have exhausted all the questions, but I want to clearly repeat that what we've been discussing in terms of the tax proposals, most of them are just proposals. They are bills. Until they go through the legal process of Parliament debating them and Parliament sending those debated acts to the President, and actually the President approves them through assent, then until then they become law. So my probably closing comment is taxation is a key element in the government budget because it's the major source of revenue for government, and as per the law, taxation, once the law has been assented to charge tax on an item, any person has an obligation to voluntarily comply. Our tax system is on voluntary compliance. And two, if you don't know the law, that one does not absolve you from that obligation. And of course, there are penalties and interest if you don't comply the law in a timely manner. So I think it is important to urge all our clients, our viewers, and the people who have spared time to come and listen and spare time to listen to this webinar and the conference call, that please keep close to your tax advisors. If you don't have one, EY is able and willing. Come talk to us. We can be able to advise you. Then you can be able to do your business in a proper way, and your tax cost will be properly managed so that it doesn't become a key constraint in your business growth. And I want to, is there anything? Okay. So for the press in the room, for those who are still online, you can keep and listen to these questions. We are still having enough time to deal with the questions from the press. You've heard what we have in for the budget and as well as the proposals. So I open the floor now to the press to ask the questions to my panelists, then we can be able to deal with them.
Thank you very much. Thank you very much, the panel. This has been very, very informative. We have before us journalists from different media houses. And now that you've finished your very eloquent presentation, I'd like to find them to have an opportunity to ask questions. Yes. Kindly introduce yourself, the media house you're coming from, and then ask the questions. If you could please stand.
Thank you very much, gentlemen, for the wonderful presentation. My name is Douglas Chikonyogo. I work with TechJaja, an online technology blog. I have a couple of questions. I think most of them will be directed to Prosper. For starters, kindly advise us on the implications of the taxation of commission on payments made to payment service providers. This is under the Income Tax Amendment Bill. And then secondly, elaborate more on the new duty rates that are going to be attached to the withdrawals from the banking agents. That's the 0.5%. What could be the implications, and would this make service delivery harder, especially as we approach a situation where we want to extend services to the unbanked communities in the country? And then lastly, with the 100 shillings added to the fuel rates, do we expect a growth in the adoption of electric vehicles, since they now have a tax waiver in the same proposals that are tabled? Thank you very much.
You'll share between Robert and Prosper Robert will deal with the income tax ones, and Prosper deal with the ones to do with duty.
Okay, thank you, Douglas. Yes, there is a proposal to have a withholding tax of 10% on commissions paid to payment service providers. And when it comes to this amendment, government is actually targeting the likes of Yo Uganda, PayBill, EasyPay, Wave, PayNow, among others. But most importantly, it comes in to also cover the agency banking, the agents. And I'm tempted to think this is it's being brought in to align with the other agents. We have seen in the recent past that the insurance agents are also suffering 10%, the advertising agents, and mobile money agents recently. So it is possible that now government perceives it that the agency banking space has actually grown, but then also they might want to create an equitable playing ground for all the agents. And that could explain the reason of the 10%.
And also in addition, like we said, there is some budget constraint. Government is also looking, what else can we bring into the tax net? So some of the measures are generally, like he said, looking at either evening out the playing field, but also they have to look at where else can we actually create more revenue. And some of the areas which have been exempted before, we will see them slowly and slowly getting into the tax net. Can you deal with the...
Thank you.
Yeah.
I can take on the question from Douglas. The issue around service delivery vis-a-vis this tax that is going to happen on withdrawals through payment systems. I think, as I mentioned earlier, it's going to impact on service delivery, on the attractiveness of that sector or subsector, which was actually helping to reach the unbanked and bring in more savings into the banking system. So because people be afraid to use the payment systems platforms, because if they put in their money, then they'll get it out, there'll be as they get it out, there'll be a cost of 0.5% on the value of the withdrawal. That can be substantial amount and a big cost to the users. Around the 100 shilling increase on or excise duty increase, and whether it will impact the growth in adoption of electric vehicles, I think it's an interesting question. But what I believe at this point, this is largely a measure from government to raise revenue. There were also a couple of amendments around attracting investment into the manufacturing of electric vehicles, which are separate incentives that came through within the excise duty, stamp duty, and VAT Act. So the two are not related, directly related. But it's also arguable that as we look forward to a greener economy and we're trying to put in place carbon mitigation measures, excise duty in future may be used as a measure in tax policy to drive aspects of climate change and discourage the use of vehicles that emit carbon. Thank you.
Thank you very much. Thank you, Prosper. Thank you, Robert. Our next question comes from...
Thank you. Thank you. My name is Eva Namugabi. I work with Radio 1 and Kavoz Kubiri. My first question goes to Alan. In your submission, you say that you foresee increased borrowing by the government to develop the infrastructure? Is it borrowing locally or external borrowing? Then that's aside. What are those? We know that government is among the things it's trying to do is to reduce on its borrowing. Going to the new budget, what are the best practices that you would advise for this to be tamed? Then the other question goes to Prosper. Just to you talked about the mobile money tax of the 0.5%. How is it deterring the development of the country in quotes? Thank you.
Yes, we can respond to those. Alan, you can start with that, and then Prosper can deal with his side. Then after that part, we shall deal with 2 additional questions which came through before we go to the next press question.
Yeah, thank you, Eva. You put the right question is, what options does government have? It can borrow from the domestic market, it can borrow externally, but it can also reduce government expenditure. So those are the 3 options. The best option in the circumstances, if they cannot be able to reduce the government expenditure, go for concessional external borrowing from loans at very low rates from external sources. However, like I did indicate, that kind of pattern of negotiation normally takes a lot of time. So it's normally a lengthy process. So in the event that government fails to get highly concessional loans, that's why you've basically seen in the past that they've gone to some external banks to also borrow from external banks, but a number of those loans are more expensive than the ones on concessional basis. So the best option, concessional basis, if you cannot tame public expenditure. Thank you.
Thanks, Alan. But probably also to add, in terms of government, it's a hard balance. At the point Alan said, the best option is actually to somehow be more prudent on the expenditure. But where you cannot, look for other cheaper options. And we've seen in the recent past, even last week or 2 weeks ago, the Minister of Finance was in Saudi Arabia, and one of the major missions he went there for to look for some very reasonable term loan. And I think they are looking at China as well. So they are, I think, throwing their bets here and there in that direction so that they minimize the cost of borrowing. But ordinarily, everybody has been advising there could be probably additional room for also government to manage its expenditures in a more prudent way. Thanks. So, is there anything? Yeah.
There is one question
Yes.
that Eva asked around the 5%, 0.5% on the payment systems, withdrawals of cash, and how they would deter the growth of the sector. Of course, when you look at a tax like excise duty, it creates an increase in the price of the service that is being provided. And that then could impact the demand or the ability of customers to take up the service. And if you have fewer customers taking up the service, then the growth of that sector is impeded. So there is definitely a cautious balance between the growth and also generation of revenue for supporting the government's budget for the year. So government has to look at a rate or a tax that will not impede the growth rate of a sector. And I think this 0.5% on payment systems, which is aligned with mobile money withdrawals of 0.5%, should have a similar effect as what we saw with mobile money.
before we get another batch of questions from the press, I wanted to deal with these two which came out of the online participants. One is from James Opio. Why doesn't Parliament actively consult with private sector to come up with proper laws? There's this other one, because you guys, you sound very knowledgeable and resourceful. Thanks, James. Many thanks for the compliment. But on that question, generally government starts their budget cycle early, and through the Ministry of Finance, Tax Policy Department, they, of course, in consultation with their lawyers, Solicitor General, and that kind of thing, they come up with the bills. Once the bills come out, they actually solicit for views from stakeholders. And as members of the Institute of Certified Public Accountants of Uganda, EY actually participates in that discussion. But you know, when you are an advisor, you are an advisor. It's like you can't force. You are looking at different things. Maybe the pressures are different somewhere. But we have always been putting all our very independent, which we think are reasonable propositions, like you are hearing. But of course, the people on the other side, on government side, even Parliament, maybe they are looking at other things, maybe for now. But otherwise, we've been participating, and we are happy to contribute, and we've been contributing. Then Kato Hezra, great presentation, thanks. My question is, will the new tax amendments for FY 24-25 contribute towards making Uganda's tax regime more progressive? That goes to Alan. Will the new tax proposals make Uganda's tax regime more progressive?
Thank you, Mohammed. I think some of the tax proposals are actually going the other way around. And like we basically did highlight, some of them are unconventional, like taxing non-business assets. If you look at the basis of having a proper tax regime that is that applies the principal canons of taxation. Some of the other measures definitely are a step in the right direction, like trying to attract equity investors. That regime was a bit, was not properly covered. But also we basically, some of the measures that we are seeing are not, like the ones on excise duty on fuel, they have a far-reaching negative impact and make Uganda less competitive. So some of them will create adverse impact on the cost of goods. Because if you increase the liter of fuel by 100 shillings, the person who is basically a taxi which is transporting you from point A to point B, to cover their costs, they're going to have a higher increase than the initial increase. So you'll have a further adverse impact affecting very low, an average person. But also someone who's transporting the food from Masaka to Kampala is also going to add a price increment. So you may have some inflationary pressures out of a small policy measure that the government has done to increase some of the taxes. Thank you.
Thanks, Alan. And also to add, generally progressive tax regimes come from a background of a strong economy. So when you have a strong economy, the tax leans more on the income, on the earnings. So unless the proposals, it's a balance between short-term, medium-term, and long-term. It's like chicken egg. So that's why the policy should not lean a lot on the indirect taxes, and they should actually be more user-friendly, more favorable for the small and medium-term enterprises. You look at even big economies like UK, US, the biggest employers are not the biggest companies. The biggest employers who generate income for the individuals who will actually start paying tax, they are the small and business enterprises. And if you can have a regime which encourages small and business and small and medium enterprises to thrive, that's why I was a bit lenient to the traders. Although I know they were breaking the law which was passed by Parliament, but I think Parliament needed to have understood the implication of that law more to the people they are really legislating for. So that person who is just trying to pick up a small investment of a mobile service company, of a vegetable juice maker, that kind of small enterprise, immediately, within no time, he's in the VAT bracket. Within no time, he needs EFRIS. Within no time, any failure, 6 million per transaction. You cannot grow that sector. So I think for me, it's a balance between short, we need the taxes, we must look for them. But let's look for them in a way that does not hit the local capacity to grow harder. And actually that's why we've been even seeing the traders, the manufacturers, they've been saying, if a foreign investor comes, you give him free land. You give him a tax holiday for 10 years. After getting his profit for 10 years, before the tax switches off, he sells capital gains free. And he goes elsewhere. He sets another company, he comes back. But the guy, the same Pija who was born here, he started his small thing. Within no time, every tax, every corner, every penalty. You can't survive. So me, I think that's why I thought the idea of increasing the threshold for VAT would have been a very good idea. And also having targeted incentives, targeting small and medium-sized small enterprises locally, so that we build the capacity who will grow and take the economy further. Then the tax base will be bigger, everybody will be bigger. You start relying more on indirect taxes because the income base is reasonable enough. And
Yes,
for the
thank
press.
you very much. Our next question.
Thank you. My name is Edwin Mohomes. I work with Capital Radio. And my question goes to, there are actually two. One is going to Robert. And I would like you to clarify on the ambiguities within the law, especially when you were explaining on the withholding tax on interest on debentures. And then to Mr. Alan, yes. I would like you to give your thoughts in regard to the remittance within 15 days, that the obsession about remitting the tax within 15 days, or else a penalty on interest, that is, what is it about the 15 days? How do you come about that? How do these guys come about with 15 days? Why are they so obsessed about it? And then maybe you can help us understand that, the penalty, must it be 15? Why not 30? And looking at our economy, and help us, please. Thank you so much.
Yes, thanks so much, Edwin, for that question around withholding tax on interest that is being paid out to non-residents. And your question is around the ambiguities in the law. Like I did say, initially initially interest on debentures, or currently interest on debentures, is exempt, so long as that debenture or that loan is widely issued. What that then means is that, number one, it makes, if it was capital, it becomes cheap. Currently, the proposal is that interest in relation to those debentures would be, withholding tax would be 2%. 2%, so long as, one, you're a financial institution. Two, if you pass that test,
you are not related. 3, you are not using it to pay back-to-back loans. So now, the first thing is that there is an introduction of 2%. Where there was 0, it is now 2%. But in addition, we realize that most of the people who are going to fall into this bracket that are going to be hit more could be actually financial institutions. Or it could be the investors who partake into the public-private partnerships. Because oftentimes these are the guys who need much more money, huge sums of money. For example, when you look at, you could look at maybe Kalangala infrastructures, which we all know of. And it means then, if, for example, the banks do not qualify, and I did give an example of, say, Stanbic. Remember, in your top 10 banks, 8 or 9 or 7, and their father or mother or their roots is abroad, for which they usually get the money from abroad to come and lend to you, Edwin. Which then means that after they have gotten money from their father or mother, who is in South Africa, UK, wherever it could be, they are going, where they are paying interest to the parent, okay, to the foreign bank, they have to withhold 15%. That is if there is no tax treaty between Uganda and that country. Which then means the first impact is that, 1, because they are also paying interest, which previously they were not paying, they are going to lend to you also at a higher rate. That is number 1. So if you're a businessman here in Uganda, your cost of doing business is going to increase. But then also, number 2, there is an exemption when it comes to payments that are being made by government, interest payments being made by government to the non-resident lender. What then does that mean for us? It means that already government, it's as if government is fronting itself as the most suitable to be lent to. Okay? Which means that, number 1, remember, partly the reason as to why these banks with foreign roots were borrowing, partly was also to invest in government securities, which are risk-free. What government is telling them? Send the money direct to me. Okay? What then also what it means that much as government is trying to ensure that it doesn't crowd out the private sector here, but even the move that it has gone for, it is almost yielding the same results. Okay? Which is quite interesting. But like I did say, you also have got to sit back and appreciate, why is government doing so? And I did indicate government is doing so because based on the international tax rules, ordinarily the government of Uganda would have the right to tax that income which has been earned from Uganda's soil. But because it didn't tax it, and Edwin, you have to go back to your country, South Africa, where you reside, and you're the bank or the lender. Your country is going to welcome you with that money, and they would ultimately tax it. So the question is, me as the government of Uganda, have I benefited? It could be a yes, it could be no, and that speaks to the balance which Mohammed was talking about. Thank you. I hope I've responded.
What causes the obsession? I think the logic is that when somebody withholds tax, it's not his money. He must pass it on to government. And that's why we basically say you must pay it to government within 15 days. The same principle also applies to some of the other taxes. Like for output, for VAT, if you basically charge VAT, you must also pay it within 15 days after the month after the end of the month. So you are basically, you withheld the tax as an agent of government, and you must pass it on to government for it to use it into the consolidated fund. That's why normally you find that whole obsession of 15 days. 15 days are seen as reasonable after you withheld. Yeah, thank you.
Okay, any other questions from the press? We still have
Yes, we still have
about 9 minutes.
All right, let's give it to this gentleman.
You want me to start? So asking me to start. My name is Martin Luda from the Daily Monitor. When I was coming in, I found Alan speaking about these figures here, but I was wondering which period you were covering. That is the tax you were talking. You mentioned tax is the main revenue to the main source of revenue to the government, which is true. And then here you go ahead and say our target is 29 trillion, right? And then you said we are at 17. That means there is something like 12 trillion still missing. What is the period you were looking at in this financial year? Were you looking at from 7 months, or what is it exactly? And that you like, so you will try to break it down for people really to understand it. And then, Robert, I was following this breakdown, but somehow I got lost, where you mentioned that here, the gasoline, you talked of gasoline, then you mentioned 100 shillings. Then again, you went ahead, you mentioned 1,450 to 1,550. Make a better clarification on that. Which product exactly? Then 1,130 to 1,230. Then again, the word came to petrol. Then petrol, it came something like 1,500. Just make it a little more clearer, because it is like it was a bit very confined. The analysis was good. What it is likely to do, what it will likely to impact on, but then just the distribution of it, it was not really very. This one is for this. This one is for this. Yeah.
So Prosper, that's for you. Alan, deal with the issue of the revenue. Then Prosper, you deal with the actual increase on the petrol products, the specific product and the increment, and from what figure to what figure. Thanks. Alan, do you want to deal with that?
Yeah, thank you. The 29 trillion is the figure that URA has a target for the whole year. Actually, the 29 trillion is the target for the domestic revenue. But remember that the domestic revenue has got two components. Has got tax and non-tax. So the non-tax is around 2 trillion, and then the URA target is 27 trillion. 23-24. Yeah. The period was as at March. Yeah.
So as at March, 17 trillion.
Okay, thank you very much, Martin. The clarity around the products, basically gasoline, which is petrol, is seeing an increase of 100 shillings from 1,450 to 1,550. And gas oil, which is diesel, is seeing an increase from 1,130 to 1,230, whereas illuminating kerosene is seeing an increase from 200 shillings to 500 shillings. Thank you.
So all these are proposals, right?
All these are proposals.
Is that all?
Yes, that's all. I think we can wind up the session and then go into our follow-up session.
Tax policy really moving in the right direction? Because you mentioned something which was very interesting, that have tax yes, tax is okay, but should not be really constraining the small ones, balancing it. So is our path really right, or something is not?
Okay, thanks. Thanks for all viewers, all the press who have been with us for the 2 hours. Actually, they moved very fast and we are still enjoying, but all good things definitely have to come to an end. We really appreciate your time and keep focusing, keep following us. This discussion will actually go on because, like we said, the budget will be read in June, and actually the tax proposals are now, as we speak, before Parliament. So they are under discussion. Parliament will go through them. Whatever they propose is 90% final because they have to go to the President for final approval. Before the bills are signed by the President, we still keep our fingers crossed. So what we've discussed, their proposals, we can only have a final word once the President has assented to those acts, and the bills become acts of Parliament which are implementable from midnight 1st July. Actually, midnight 30th June, oh, 1st July. So in terms of your last comment, it's really a balancing which we think needs to be looked at more. And we think from a technical perspective, we normally advise you, like you definitely have to eat, even if you want to invest. But don't eat it all, don't invest it all. So have the right balance. We think when you have a tax policy which picks a lot of tax from the small and medium and the indirect tax, we think you are very close to eating it all. You rather have a balance where we need tax, but give some relief so that these people can have some slightly better room. I think in my view, it would be have been even better from a policy perspective. You have a policy which favors more the small and medium term than the big boys. The big boys are already big anyway. Even if you tax them something big, they will not die, they are still okay. But this other small man, what you think is small is actually very big for him, and it will kill him before he even reaches his 5th birthday. So I think the policy, from a policy perspective, the balance to some of us, we think it should shift a bit towards local as opposed to the big boys who are somebody coming is an investor, then he should have enough money. Why do you give him free something, free something, free something? And the local person competing with that guy has nothing. To us, we think that balance needs to move a bit. Otherwise, thank you so much. Keep following us. We shall have our budget discussion where if the budget is ready on 13th, we shall have a breakfast on 14th. And now we break down further with even more concrete answers when the bills are already passed into law at that point in time. Otherwise, thank you so much, all who have been following us online. We really appreciate your time, and we pray that God bless you. Enjoy the rest of the day, and take care. Bye now. Hey, you want a good picture? Okay.